Daniel here, Generational Wealth Concepts. Going to talk about, in this video, premium finance. Why would I do this and how does that work? So there are multiple ways of financing a life contract. So it depends on the strategy. Most of the premium financing nowadays is done with an indexed universal life. And there is one strategy where you pay basically 50% of the amount for 5 years, and then the other 5 years, it is covered in its entirety by the finance company. And it's 10 pay, and at year 15, I believe, it's been a while since I've looked at one of those, but or done one of those, but nonetheless, it's year 15 in most cases with most of the premium financing. There's a few where it goes longer, but at year 15, the finance company takes back their money with interest. Out of the cash value, they take a loan against it, and then since they took a loan and you're getting credited each year growth-wise, you're getting credited on the full amount. So it creates an income for you, and there's a formula in which basically you can utilize, and the software does this for you, but you can go through and you can take income of a certain amount. So say it's $50,000 a year, you can say it's $50,000 a year, and with the growth and all, you, in most cases, don't run out of money. So you'll get $50,000 a year for however long. And what people will do is the same thing with what I talked about in the annuity laddering video, is they'll stagger these things. They'll pay their 5 years and their money, and then they'll start a new contract and do another retirement plan where they'll do another 5 years. And they just keep doing that for 3 or 4, maybe 5. I mean, it just depends on when they started and what their income looks like. And if they can afford to do that, they'll continue to do it. So in these scenarios, they'll stack these and then take income at staggered intervals, and overall they end up with quite a bit of money. So, and then there's some, what they'll do is they'll pay all 5 years up front. It goes into a trust that the money's taken each year and is paid on the premiums paid from this trust. So and the finance company controls that, and they'll pay that. And then if they have money, they're well-to-do enough or well off enough, they'll take it and they'll do another one the following year, and then the following year and the following year, they will do these just the same. And then they're able to take the income, because whenever they hit that plateau of 15 years, well, year 15 for each one is each year following. So there's different strategies with that, but your traditional is where you pay, that also depends on the finance company that's willing to finance it. And most of the time in these traditional ones, your net worth, so the traditional one only, the other one, you only have to have like $150,000 or $200,000 a year in income. And I say only, that's still great income, but in comparison, you have to be worth $5 million or more to do your traditional, premium financing. So, and in those cases, it depends on the company, whether you pay interest only, whether you pay interest and some of the principal, the small amount of the principal. Maybe you don't pay all the interest. Maybe you pay a portion of the interest, and then they do the same. They can do it whenever they get to year 15. Now there's another newer version where they utilize a line of credit. So you put in money into this policy, and once you accumulate $100,000 in cash value, then they'll open you up a line of credit. And then from that line of credit, what they do is they start making more premium payments outside of that and it leverages your policy, and then they actually don't take payment. They're not at 15 years. They will take it from the death benefit whenever you pass away, which is a little more interesting because you don't have the drag of the loan from the policy, or against the policy, I should say. That interest rate, you don't have that interest dragging you down. Where, and I say drag you down, it's usually low enough, but it creates some drag. It's not just free of it. So in this case, there's no interest that directly impacts the growth of the policy. Now, on the death benefit side, yeah, they will take a larger sum because you're accruing interest at 2-3%, whatever it is, for a much longer period of time. So say it ends up being 30 years, well, that can be significant, but they set up the policy to where it will pay off, and then it's creating your desired income. So there's calculations that come into play. Software usually does all of this, but it's another concept. And, why would you do that? Is one, you can either take income, and really this was supposed to be, there's more than one option, and realistically, you would do it for income or for retirement planning, like with those videos. What I've been talking about on some of these videos anyway, is the life insurance retirement plans, or it would be for estate planning. And estate planning is a whole other ball game in which you would do it and why you would do it. But there's only one real strategy, which is the traditional way. I guess you could make the other one work. You just wouldn't take income for making that work and why you would make it work. And I'll do another video on that. Please like, subscribe, hit the notification bell. And in the next video, I'll be talking about the estate planning version of it. See ya.